You know, economics can feel like this super complicated puzzle, right? But what if I told you its biggest ideas are really all about the choices you and I make every single day? In the next few minutes, we're going to unpack those ideas. And we'll start with a question I'm pretty sure you've asked yourself before. So let's start with something we all get, that daily cup of coffee. You ever look at the price and just wonder why? Why does it cost that much? It might seem totally random, but it's not. That little price tag is actually telling a hidden story about our world. So let's decode it. All right, here's our first big idea. Price is a signal. Think of it as the market's secret language. It's communicating vital information, all without saying a single word. It's a message about what we value, what's scarce, and where things should go. And this is the perfect example. Think about a Starbucks smack dab in the middle of a busy city. You're not just paying for coffee beans and milk. Nope, you're paying for that prime real estate, a super scarce resource that a ton of people want. That high price, it's a big flashing neon sign that screams high demand for very limited space. And this whole dynamic really boils down to two fundamental forces. Supply, that's how much of something there is, and demand, that's how much people want it. Just imagine them in a constant tug of war. The price is the exact point where they find their balance. At the end of the day, markets are always looking for that sweet spot, that balance. So when way more people want something than is actually available, the price naturally has to go up. This simple little dance is playing out millions of times a second, and it's how everything from our coffee to our cars gets distributed across the entire economy. But listen, these market forces aren't just some abstract thing happening out there. Markets are made of people, you and me. And to really truly understand economics, we have to understand what makes us, well, us, what makes us tick. And this is all about the incredible power of incentives. An incentive is basically just any reason that encourages you to act a certain way. So if the government puts a heavy tax on gas, that higher price at the pump is a massive incentive to maybe drive a little less or hop on the bus. Our behavior changes in direct response to these signals. But this is where it gets really fascinating. Because if economics was just about us making perfectly rational choices, it would be pretty simple. But we're human. We have emotions, biases, and gut feelings that play a huge role in the decisions we make. The psychologist Daniel Kahneman gave us an amazing way to think about this. He said we basically have two systems in our brain. System 1 is fast, it's automatic, it's our emotional gut reaction. System 2 is slow, logical, and deliberate. And here's the catch. Most of the time, our emotional System 1 is the one in the driver's seat. Just think about the stock market for a second. When prices start to dip, your logical System 2 might be saying, okay, hold on, let's analyze the long-term data, but your emotional System 1 is just screaming, get out now before you lose everything. That panic selling is a perfect example of our psychology just steamrolling pure economic logic. Okay, so if prices are signals and our responses to them are complicated, how do we make good policy? This brings us to our third key idea, the importance of looking past the immediate effects to see the hidden long-term consequences. The economist Henry Hazlitt absolutely nailed this. He argued that the single biggest mistake in economics is only seeing what's right in front of your nose, the visible benefit for one group, while completely ignoring the unseen costs for everyone else down the line. Take something like government subsidies. The immediate impact is super clear to see. A specific industry is protected, some jobs are saved. Great. But what about the hidden consequences that we often miss? Well, maybe consumers end up paying higher prices, and those protected companies have way less reason to innovate. The bottom line is, in economics, there's pretty much always a trade-off. Sometimes a market price just doesn't tell the whole story. These hidden spillover effects have a name. They're called externalities. For example, a factory might produce really cheap stuff, but if it pollutes the river while doing it, the whole community bears the cost of cleaning it up. That cost isn't on the product's price tag, which means the market has a blind spot. And this is exactly where a government might step in. A tax on tobacco isn't just about raising money. It's really an attempt to make the price of cigarettes reflect their true social cost, including all those future healthcare expenses. It's about trying to correct the market's blind spot. So, we've looked at how prices, incentives, and policies work. But let's zoom way out. How do these principles explain one of the biggest questions of all? What is it that makes some countries prosperous while others struggle? Economist Thomas Sowell argues that it's not really about natural resources. True prosperity comes from the quality of a country's institutions. The underlying rules of the game. Things like stable property rights, a legal system you can trust, and open markets. These are the foundations that allow a country to really use its resources well. I mean, China's story is just a powerful, powerful case study. For decades, it had a centrally planned economy, and growth was pretty slow. But then, when it started shifting towards market principles, opening up to global trade, the result was an economic transformation that lifted hundreds of millions of people out of poverty. It just shows you the system you build on matters enormously. So, where does all this leave us? We've seen that markets are incredibly powerful, but people aren't always rational, and policies can have all sorts of hidden consequences. This all leads to our final critical understanding. Economics just isn't a simple formula where you can let markets run wild and expect the best. The 2008 financial crisis was a painful, brutal reminder that markets, especially really complex ones, can fail spectacularly without smart oversight and regulation. The best economies in the world are always trying to find that balance between market freedom and effective governance. Okay, let's recap the big takeaways. First, price is a signal that guides resources. Second, our decisions are driven by incentives, but also by our all-too human biases. Third, we always have to look for the unseen, long-term consequences. And finally, while markets are incredibly powerful, they're not perfect. They need strong institutions and good rules to work well. And that leaves us with one final thought. Economics gives us a powerful lens to understand our world, but it's a tool, not a rule book. The real challenge is learning how to use that tool wisely to build a better future. So I'll leave you with this. What do you think is the biggest economic challenge that we're all going to have to solve?